My name is Pavinash Analaki Manoji and my metric number is 312781. So I'm going to talk about introduction, which is background of our chosen company. So Nestle is one of the biggest multinational corporation on the planet and one of the largest companies that produce foods and beverages. It was founded by Hendrik, Aka Hendrik, which we call Aka Hendrik. Okay, it was firstly founded in Vevey, Switzerland in 1866. It is still headquartered until today. If we talk about Malaysia, Nestle was established in Malaysia in 1912 under its original name, which is Angola Swiss Condensed Milk Company. Currently Nestle's head office is located in Mutiara, Damansara in Petaling Jaya, Selangor, with 6 sales office and over 5,000 employees through the country. So there are also 7 plants in Malaysia where Nestle manufactures product with over 300 halal items. Let's begin with analysis SWOT, which is strength, weakness, opportunities, and threat. So the strength is unmatched. First is unmatched research and development capability. Second is strong geographic presence with one of the best geographical diversified revenue sources. And third is unrivaled product and brand portfolio. And the weakness is first is criticism over high water usage, selling contaminated food, anti-unionism, forced child labor, and using other unethical practices. The second weakness is contamination, food recalls. And the third one is opportunities, which is first clear and accurate labeling indicating of any harmful product, which is the product is harm or not. And the second one is transparency in material sourcing. And third is growing number of small Silicon Valley based on food startup. And the fourth and the last for opportunities is growing ready to ready drink, which is RTD tea and RTD coffee markets. And the last one threat is first poor quality water and its scarcity. Second is increased competition in the beverage and food industries. And the third and last for threat, which is the price of coffee beans could significantly rise.
Good day everyone, my name is Carly G and my number metric is 312936, and today I will be presenting my individual contribution to our financial management group assignment on Nestle Malaysia Berhad. For this assignment, I was responsible for analyzing the liquidity ratios, specifically the current ratio from 2020 to 2024. Besides completing my own section, I also took a leadership role in coordinating our group work. I helped divide the tasks among group members, share relevant information and resources, and ensure that everyone understood their responsibilities so that the assignment could be completed efficiently and on time. Now, I will explain the liquidity ratio analysis of Nestle Malaysia Berhad. Liquidity ratios measure a company's ability to meet its short-term obligation using its current assets. This ratio helps evaluate whether a company has sufficient liquid resources such as cash, inventories, and accounts receivable to pay its current liabilities when. First liquidity ratio analyzed is the current ratio. The current ratio is calculated by dividing current assets by current liabilities. It shows how many ringgit of current assets are available to cover every 1 ringgit of current liabilities. For Nestle Berhad, the current ratio was 0.59 to 1 in both 2020 and 2021. It increased to 0.71 to 1 in 2022 before declining to 0.61 to 1 in 2023 and further decreasing to 0.55 to 1 in 2024. Based on this result, Nestle Malaysia Berhad's current ratio remained below the ideal benchmark of 1 to 1 throughout a 5-year period. This indicates that the company's current liabilities were consistently higher than its current assets. suggesting a relatively weak liquidity position and a limited ability to cover short-term obligations using current. However, despite the low current ratio, Nestle Malaysia Berhad continues to operate successfully. This is because the company benefits from strong operating cash flows, efficient inventory management, and a strong market position as one of the leading food and beverage companies in Malaysia. These factors help support its short-term financial commitments even with a lower current ratio. In conclusion, although Nestle Malaysia Berhad's liquidity position is below the ideal level, the company remains financially stable due to its strong business performance and efficient operations. So, that's all from me.
Good morning, Doctor. And my name is Chu Weibing, and my matrix number is 310023. I will be presenting the asset management ratios of Nestle Malaysia Berhad for the period from 2020 to 2024. Asset management ratio, also known as efficiency or turnover ratios, are used to assess how effectively a company utilizes its assets to generate sales and support business operations. In this analysis, we focus on three key ratios, which are inventory turnover, fixed asset turnover. First, let us look at the inventory turnover ratio. Inventory turnover measures how efficiently a company manages and sells its inventory. A higher ratio generally indicates better inventory management and stronger sales performance. The inventory turnover ratio decreased from 5.77 times in 2020 to 4.13 times in 2022. This suggests that inventory moved more slowly during this period. However, the ratio improved significantly to 5.8 times in 2023, indicating better inventory efficiency and stronger demand for the company's product. In 2024, the ratio decreased slightly to 5.22 times, but it remained at a relatively healthy level. Overall, Nestle Malaysia demonstrated efficient inventory management throughout the. Next, I will discuss the fixed asset turnover ratio. This ratio measures how efficiently the company uses its fixed assets, such as property, plant, and equipment, to generate revenue. The ratio was 3.8 times in 2020 and slightly decreased to 3.74 times in 2021. It then increased to 3.99 times in 2022 and reached its highest level of 4.03 times in 2023. This improvement indicates that Nestle Malaysia was able to utilize its fixed assets more effectively to generate sales. However, the ratio declined to 3.44 times in 2024, suggesting a slight reduction in fixed assets efficiency. Despite this decline, the overall performance remains. Lastly, let us discuss the total assets turnover ratio. This ratio measures how efficiently the company uses all of its assets to generate revenue. The ratio increased slightly from 1.89 times in 2020 to 1.82 times in 2021, before decreasing marginally to 1.88 times in 2022. It then improved to 1.89 times in 2023, which was the highest value recorded during the period. However, the ratios declined to 1.871 times in 2024, indicating lower efficiency in utilizing total assets compared to the previous year. Nevertheless, the ratio remained relatively stable overall, showing that the company was generally effective in generating revenue from.
Hi sir, I'm Vityanaya, daughter of Sudhakaran. My metric number is 312713. Now I'm going to continue our presentation with the part leverage ratio. Leverage ratio can be defined as a financial ratio which contributes to measure how much a company utilizes the debt compared to its own funds or assets to finance its operation. There have two types of leverage ratios which we calculated in this assignment. First of all is debt to equity ratio and the second one is debt to assets ratio. The formula that we utilized to find out the value of the debt to equity ratio is total liabilities divided by total equity. And the formula that we used to find out the debt to assets ratio is total liabilities divided by total. Now I'm going to continue my presentation with the debt to equity ratio, which is a type of leverage ratio. Based on the analysis in 2020, the ratio stood at 4.14 to 1. It dipped slightly to 4.12 to 1 in 2021 as equity grew a bit faster than the liabilities due to a small sign of improved capital structure. But in 2022, the ratio climbed to 4.67 to 1, driven by a much larger increase in total liabilities compared to the shareholders' equity, meaning the company used more debt to fund its operations. Then in 2023, the ratio fell to 4.29 to 1. According to the analysis, this happened because total liabilities decreased while equity increased, and this lowering the financial risk and strengthening Nestle's position. However, in 2024, the ratio spiked sharply to 5.67 to 1 and because total liability rose substantially while total equity actually dropped, likely because Nestle raised more borrowing from financial institutions to continue business operations. Overall, Nestle maintained a high debt to equity ratio throughout this period. This indicates a heavy reliance on external financing. That's something investors and analysts would watch closely as it raises both potential returns and financial vulnerability. Now I'm going to continue my presentation with the debt to assets ratio, which is a type of leverage ratio that we calculated in this assignment. Based on the analysis in 2020, the ratio was 0.81 to 1. It dropped slightly to 0.80 to 1 in 2021 because assets grew more faster than the liabilities. As the Nestle brought in more vehicles and machines. Then in 2022, the ratio edged up to 0.82 to 1. It is because liabilities spiked significantly while assets grew more slowly as the company borrowed more but added few new assets. In 2023, the ratio fell back to 0.81 to 1. It is because assets increased slightly while the liabilities decreased, likely because Nestle paid down some debt and increased credit sales, which boosts the assets. However, in 2024, the ratio jumped to 0.85 to 1. It is because liabilities grew substantially while assets only grew modestly. This points to aggressive new borrowing during the year. Overall, the Nestle company shows a significant reliance on debt financing across the period, though its financial stability remained relatively steady.
Good afternoon, Dr. Wei Hai Tian. My name is Tan Wing Si, metric number 310067, and today I'm going to talk about profitability ratio. So a profitability ratio measures how effectively a company generates profit relative to its sales, asset, or equity. It is commonly divided into margin ratio, which shows how well sales are converted into profit, and return ratio, which assess how efficiently assets and shareholders' equity generates return. So there are three common examples, which includes profit margin, return of asset, and also return
The first one is profit margin. So profit margin shows how much profit a company makes from its sales after all expenses are deducted, and it measures how efficiently the company controls its costs and turns revenue into profit. A higher profit margin means the company is more efficient and keep more profit from each unit of sales, while a lower margin means higher costs or weaker profitability. So there are examples for the year 2020. We have the data from Nestle, which is 55271,300, while the revenue is 454,121,8000, and then we just take net income and divide it with revenue, and then we have 10.21% for that year of 2020. So in this next slide, we have a 2020 until 2024 profit margin. So you can see from here, 2020 to 2023, the profit margin stayed quite stable, slightly decreasing from 10.21% to around 9.3%. This means the company was consistently able to control its costs and maintain profitability during these years. However, in 2024, the profit margin dropped more noticeably to 6.68%. This indicates that cost increased or profit fell compared to sales, making the company less efficient at turning revenue into profit in that year. Next, we're going to talk about return on asset, or ROA. So ROA measures how effectively a company uses its assets to generate profit. It shows how much net income is earned from the company's total asset. A higher ROA means the company is using its assets efficiently to generate earnings, while lower ROA suggests that assets are not being used as effectively or that profit growth is slower than assets. So the formula for ROA is net income divided by total asset, and the data for 2020, the net income is still the same, which is 55271,300 for net income, while the total asset for that 2020 year is 2861371,000. So we just take the net income and divided by the total assets, and then times 100, we have 19.32% for the year 20. So now we have the data of ROA from 2020 to 2024. As you can see, ROA stayed very strong at around 19%, showing Nestle was generating a high level of profit from its assets and using its resources efficiently. In 2022, ROA decreased to 17.44%, suggesting a slight reduction in asset efficiency, possibly due to higher costs, increased asset, or slower profit growth compared to asset growth. In 2023, ROA improved again to 18.49%, showing better use of assets and a temporary recovery in profitability. However, in 2024, ROA dropped significantly to 11.39%, indicating a much lower ability to generate profit from assets, possibly due to lower profit, rising costs, or rapid asset. Lastly, we have return on equity, or ROE. ROE measures how effectively a company generates profit from shareholders' equity. It shows the return earned by investors based on the investment in the company. A high ROE means strong profitability, but it can also be affected by a low equity base or the use of debt. So it should be interpreted carefully. So the formula for ROE is net income divided by total equity of that year. So the net income is still same, while the total equity is 557,136,000. So for the example, for the year 2020, we take the net income and divided by total equity times 100, we have 99.21%. So after calculate from 2020 to 2024, it is clearly that ROE remained extremely high, staying around 97% to 99%. This means the company generated a very large profit compared to its equity. However, this unusually high level is mainly due to a relative low equity base rather than a only strong operational performance. Even though the ROE is very high, it should be interpreted carefully as it may not fully reflect sustainability profitability. In 2024, ROE dropped significantly to 75.91. Although this is still high, the decrease shows that the company is generating less profit from shareholders' fund compared to previous years, which could be due to lower net income.
Comment, which is from an evaluating Nestle Berhad 5-year from 2020 to 2024 for financial ratio. We believe the company will consider making a significant contribution to its long-term sustainable investment. Nestle Berhad is expected to continue to remain in an excellent market position, good profitability levels, and will be able to make efficient use its assets going forward. Okay, Nestle has recorded strong profit each year since 2019. The company has maintained stable profit margin, which is around 9% to 10% over the last 3 years because they control costs and have been able to generate regular income. The profit margin fell slightly to 6.68% in 2024, but still allows the company to remain profitable in that year. Okay, and Nestle inventory turnover ratio were measured at an average of over 5 times annually expect for 1 year, which is 2022. A strong inventory turnover ratio suggests that Nestle is quickly and efficiently selling the product they have in stock, which indicates the company able to survive and to generate healthy cash flows from its operation. And they also generate the healthy cash flow from its operation. Nestle product portfolio, which is include brand like Milo, Maggi, Nescafe, and others. Other financial risk exist for Nestle is include liquidity ratio, liquidity and leverage, which both of these thing is a significant threat to a company. So in conclusion, Nestle Berhad financial review of 2020 to 2024 reveals a number of strengths in its finance, even though the company has to deal with several financial risk areas. So during the period, the company has been profitable, had good stock management, and produced impressive returns on equity and assets. Additionally, there were also few areas uncovered by our analysis which should not be disregarded. For example, for the entire period, the company has liquidity ratio which are under the eyelid ratio, meaning the company will have difficulty meeting short-term payment obligation related to their current asset levels. In addition, increased leverage ratio indicates that Nestle debt to debt equity ratio will be rising, showcasing an increase in reliance of debt financing to fund growth, particularly in 2024 compared to other 4 years of the time period covered. And increasing in dependency of financing from debt source will expose the company to an increase in their level of financial risk in the financial environment. Regardless, Nestle Berhad is still a good candidate to long-term investments because of its consistent profitability, efficient operational practices, and strong reputation in the food and beverage industry. Nestle should continue working to improve their liquidity position and practical management of their debt levels so that they remain financially stable over long term and incur few future financial risk.